What if I told you that on February 15th, buying just 20 ounces of silver could put your name in a federal database? Sounds extreme, right? But it's already happening. A new reporting law just activated, and the $600 threshold isn't an accident. It's designed to catch you, not the big players. I traced this back through decades of financial crackdowns, and the pattern is chilling. Smash that subscribe button, drop a like to support this channel, and watch the full story. Because what comes after surveillance is something history has shown us before. February 15th didn't appear by accident. Buried in regulatory updates, this activation date marks when silver transactions above certain amounts must be reported directly to federal databases. The timing stands out: mid-month, mid-quarter, avoiding the usual January 1st rollout that most tax laws follow. This irregular scheduling mirrors a pattern seen in 1933, when Executive Order 6102 took effect on May 1st, catching gold holders off guard between typical fiscal deadlines. Dealers received compliance notices in late January, giving them barely 2 weeks to update systems, train staff, and notify customers. That's the anomaly. Laws this significant typically allow 90 to 180 days for implementation. The rushed timeline suggests urgency from above, like a net being pulled tight before anyone realizes they're inside it. What remains unclear is whether existing silver holdings will retroactively fall under scrutiny, or only future purchases. That single unanswered question has already changed buying behavior across the market, even before the law officially activates. The mechanism works like a tripwire. Any single silver transaction exceeding $600 triggers a Form 8300 filing, the same tool originally designed to catch cash-based money laundering. Dealers must collect your name, address, social security number, and itemize exactly what you bought. This data flows directly into FinCEN, the Financial Crimes Enforcement Network, where it sits alongside banking records and cryptocurrency exchanges. The $600 threshold is the red flag. In 1985, when Form 8300 launched, that limit was $10,000. Adjusted for inflation, that's roughly $29,000 today. Instead, they dropped it 20-fold, casting a net wide enough to capture casual buyers, not just bulk investors. The analogy is simple. It's like lowering the speed limit from 65 to 15 and calling everyone who drives a reckless offender. What remains unknown is how this data will be cross-referenced with tax filings, bank withdrawals, or future asset declarations. That integration capability is already built. Activation is just a policy decision away. History shows a 3-step pattern: first surveillance, then restriction, then confiscation. In 1933, Executive Order 6102 required Americans to surrender gold coins and bullion at fixed prices. Before that order, the government quietly tracked gold flows through bank reporting requirements introduced months earlier. The surveillance came first, the seizure followed. In 1974, when gold ownership was legalized again, silver remained under tight dealer reporting through the Commodity Futures Trading Commission. By 2011, new IRS rules expanded, Form 1099-B requirements specifically for precious metals, tightening the net just as silver hit $48 per ounce. The playbook repeats: monitor before you act. This February 15th threshold mirrors those earlier preparatory moves, like installing cameras before announcing a curfew. The anomaly is the speed. Previous reporting expansions took years to phase in. This one launches in weeks. What remains unanswered is whether current economic stress will accelerate steps 2 and 3, or if surveillance alone is the endgame this time. Dealers are reacting like they've seen this script before. Within days of February 15th approaching, major bullion retailers updated their websites with new purchase limits, splitting transactions just below reporting thresholds, and some stopped accepting cash entirely. These aren't suggestions from lawyers. They're defensive moves based on enforcement expectations. The red flag is the uniformity. Dealers across different states, different sizes, all pivoted simultaneously, suggesting coordinated guidance from industry groups or direct federal communication. In 2013, similar dealer behavior preceded an IRS crackdown on coin shops that had failed to file forms properly, resulting in account freezes and criminal referrals. The analogy is straightforward. Dealers are acting like the first row of dominoes, bracing before the push. What remains unclear is whether enforcement will focus on dealers who fail to report or customers who try to avoid thresholds through structured buying. That distinction determines who bears the legal risk, and right now, nobody knows for certain. The $600 threshold sounds reasonable until you calculate what it actually captures. At current silver prices around $30 per ounce, that's just 20 ounces, a single tube of American Eagles, or a small stack anyone might buy as insurance against inflation. This isn't targeting wealthy investors hoarding thousands of ounces. It's designed to catch everyday people making modest purchases. Historically, financial surveillance always claimed to target the wealthy. The original 1970 Bank Secrecy Act promised to track large cash movements. Yet today, even $600 Venmo transfers get flagged. The pattern is threshold creep. Start high, then lower it until everyone's inside the net. The anomaly here is intentionality. Large buyers already get reported under existing anti-money laundering rules. Adding a $600 silver-specific trigger serves one purpose: visibility into the broader population's inflation hedging behavior. It's like installing a census that only counts people buying lifeboats. What remains unknown is whether this data will inform future policy, including potential purchase limits or taxation changes. Silver sits in a dangerous middle. It is both an industrial metal and a monetary escape hatch. Solar panels, electric cars, medical tools, and electronics all rely on silver. At the same time, ordinary people buy coins and bars when they lose trust in cash or banks. That dual role makes silver harder for governments to ignore. History shows this tension. In the 1960s, the US removed silver from coins because industrial demand and inflation made metal value exceed face value. In 1980, when silver spiked near $50, regulators rushed in with trading limits, blaming market abuse, but really protecting the financial system. The irregular data point now is shrinking above-ground inventories while industrial demand keeps rising. Adding new reporting on top of that looks less like routine policy and more like a control measure. It's like tracking every spare tire sold right before announcing fuel shortages. The open question: is this about tax or about shaping who gets access to real metal when shortages bite? The pattern is now hard to ignore. First, a quiet February 15th start date. Then an unusually low $600 trigger. Next, fast dealer changes, shrinking inventories, and a law that watches small buyers more than big players. Each piece alone could be random. Together, they echo the same script used before gold bans, silver crackdowns, and new tax rules in past crises. History shows that surveillance is rarely the final step. It is usually the test phase, like marking doors before deciding which ones to lock. The unsettling part is timing. Heavy debt, high inflation, and rising metal demand are all hitting at once. What remains unknown is how far policymakers plan to go. Higher taxes on silver gains, limits on cash purchases, or even pressure to keep wealth inside digital accounts. The window before February 15th is not just about one law. It is a warning signal of how quickly financial rules can change when trust in money starts to break. In the end, the new silver reporting law is less about metal and more about control. The shift to tracking small silver buyers fits a long pattern. When paper promises weaken, authorities focus on anything that can escape the system. We have seen versions of this before. In 1933 with gold, in the 1970s with currency controls, and in the 2010s with expanding bank and payment surveillance. Surveillance leads to targeting, and targeting often leads to restriction. The evidence now points in a single direction: a future where privacy and saving and trading real assets steadily shrinks. Whether this ends with heavier taxes, rationed access, or simply constant monitoring is still unclear. But the message is clear enough. February 15th is not just a date on the calendar, it is a marker on a longer road toward tighter control over how ordinary people protect their wealth.